Hello everyone, welcome to this video. In this video, you will be learning about ratios which you must check before investing. If you open any of the broker's terminal, any of the application like Grow, Zerodha, Upstocks, you will find that and you go and click in the share of any company. You will find certain ratios are there like EPS, PB ratio, PE ratio, all these ratios. So you must have a deep knowledge about what these ratios are trying to say. If you can understand and analyze these ratios, then you can purchase shares. Don't purchase share like you like a company and you purchase. Thoroughly check all the ratios. Ratio is basically is something that indicates the efficiency of the organization. If you know about these various ratios, you can invest the shares accordingly. The first ratio is earning per share EPS. It depicts the earning of the company on a share. It is calculated for equity shareholders. EPS talks about earning of the company after deducting extraordinary items from the net income. This EPS talks about the earning that what company has earned after deducting the extraordinary items. Extraordinary items includes those transactions which occur only once in a year, like which results in profit or loss, like machinery is sold, a building is sold, etc. EPS is a profitability ratio. A company have fluctuation in EPS isn't a viable investment option. Steady growth is important. EPS should be compared with its peers. Means suppose we talk about power. If I talk about NTPC, it's a power based company, and if I talk about Power Grid, it's also a power based company. So I have to check that which one is more better in EPS. A constant rate is quite important. Every time we have to compare in a particular industry. Suppose we talk about this power industry as well. So I will compare between Adani Power, I will compare between Tata Motors. I will see that which one is more better, which ratio is increasing steadily. So EPS is calculated as net income by weighted average common stock of the company. So increase in EPS is always good. PE ratio, price earning ratio. This involves whether the share is expensive or cheap. If PE ratio is 3 is to 2, it means the share market price is 3 while earning on one share is rupees 2. It means that investor gets rupees 2 as compared to amount raised of rupees 3. If P ratio is high, it means your share is expensive. Overall, expensive, overvalued, and vice versa. So, this question mark will be replaced by a slash. Sorry for that. So a P ratio is high. It means that your share is either expensive, overvalued, or vice versa. If P ratio is high, it speaks of greater investor sentiment and company's overall past performance. Even though share is expensive, people still wish to buy it. It is known as P ratio. Higher the P ratio, the more better it is. Then we have debt equity ratio. It means the proportion of debt in the total capital of an organization. The ideal debt equity ratio is 1 is to 1. If a company has more amount of debt, means company has more legal obligations to pay interest on it. So a higher debt equity ratio is not good for any investment plan. An organization have always must have this ideal ratio 1 is to 1 or should have lower than this. It is more better. The more the debt equity ratio is, it is not good as it shows the business has more outside liabilities loan. The lower the ratio, the better it is. Then return on equity ROE. This ratio shows the profit earned and delivered by the company to its shareholders. This ratio shows the profit which is earned by the company and delivered to its shareholders. Difference between EPS and return on equity ROE is under EPS the base for calculation is per share, and under ROE it is total share. Formula is profit by total equity. More the ROE, the more better it is. Means you are getting more on the return. The return which you are getting is more. Then PB ratio, price to book value ratio. This ratio informs whether the share of a company is overvalued, undervalued, or not. Formula is market value of the share by book value per share. Suppose total asset is 10 lakhs with liabilities is 9 lakh, the net asset is going to be 1 lakh rupees. Ratio will be 1 lakh by 10,000, and 10,000 is the price of each share. So it's 100. PB ratio and ROE should go hand in hand. If there is a mismatch between them, then it's a danger sign. Okay, PB ratio and the ROE should go hand in hand. If it's increasing, it should increase. If it's decreasing, it should decrease. So higher the PB ratio, more better it is. It should means ROE and PE ratio, ROE and PB ratio must go hand in hand together. Then it's considered to be the best option. Now, like last, we have current ratio. The current ratio measures the efficiency of the firm to pay back its current liabilities. Ideal ratio is 2 is to 1, More the ratio, the better the financial position of the organization to pay back its current liabilities on time. So basically it's calculated by current asset by current liabilities. And if the current ratio of an organization is more, then the company is more financially sound to pay back its current liabilities. So this is all about this video. These are ratios which you must check before investing. Thanks for joining. Future videos will also be introduced in this Finance Simplified series, where we will be talking about different sorts of finance things. Hope you like this session. Thank you.